My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Like my friends, I'm just trying to save you a little money. My job is not to entertain, but to educate, teach, explain why days like today happen. Call me at 1-800-743-CNBC. Tweet me, Jim Cramer. The newfound rationality continues. This market's punishing the weak while rewarding the strong. It's no longer making excuses for poor performance. In some cases, it's not even embracing good performance after the monster move we've had in the last 2 weeks. That's why on the eve of the big Federal Reserve powwow in Jackson Hole, the averages got slammed. The Dow sinking 170 points, S&P down 0.43%, NASDAQ tumbling 1.67%. It's back to reality, and reality can sting. If you recall, in the wake of the bizarre unwind of that yen carry trade, the market had a quick collapse and then a remarkable 8-day resurrection that buoyed pretty much everything. Anything that's good exploded higher, and we figured anything bad was going to get good once the Fed started cutting rates. But that was then. This is now. Since the winning streak ended, we're starting to get into what I call the buyer's remorse phase of this move. Stocks that had a nice run based on nothing more than hope are now rolling over hard. And not even the knowledge that the Fed cavalry could be coming is enough to save them. Perhaps the selling's exaggerated because tomorrow's the Fed they speak in Jackson Hole, and Wall Street's already baked in the possibility of September rate cut. Can't get any better than that. Maybe the bulls think we need some sort of impossible statement like Jay Powell promising multiple rate cuts. Not going to happen. Maybe the Fed's already too late and the economy will get real ugly. Or maybe traders are beginning to fear the possibility of a Democratic sweep in November, which could lead to higher corporate tax rate, bad for earnings, and a potential witch hunt for price gouging in the aisles of the supermarket and the drugstores. I got to tell you, I don't believe in the first two explanations. Not everything gets saved by the Fed because many companies simply aren't that sensitive to the economy. Second, it is never too late for a rate cut, for heaven's sake. The turn gets delayed but not canceled, except for the companies with terrible balance sheets. The latter actually deserve to go down and even stay down if they've loaded themselves up with debt and have to start paying it back in a couple of years. But the third, politics, getting tricky. Coming into this week, I think most investors believed that President Biden was no friend of the stock market. He's pro-labor, he's not pro-capital, and I can count on two hands the number of executives that he regularly is in touch with. Biden seems tone deaf to most execs. Vice President Harris, coming out of California, the home of so many tech businesses, and with friends from business, including her very close brother-in-law, Tony West, general counsel of Uber, was perceived to be friendlier to commerce. However, this week's convention's got a lot of investors now buzzing about how a Harris presidency might be even more antagonistic to business than the Biden administration. We know there's heavy emphasis on bashing the food and the drug companies for raising prices, even as the Biden administration put through the first real attempt to have our government control the prices of some very heavily used drugs. We also know that any Harris initiative to stop price gouging will most likely be ill-fated. We need the retailers with scale to jawbone prices back down. And for the most part, Walmart and Costco have done exactly that. They've done a terrific job of reining in the suppliers and urging them to take price back down to post-COVID levels. But on the campaign trail, Harris has no incentive to acknowledge that there are a couple of good actors and bad actors. It's much easier just to use a broad brush, bash big business for collectively taking advantage of the pandemic to raise prices. They can't come down without the help of the government. That's the wrap. These factors can all explain some of today's weakness, but honestly, what I'm most concerned about is the prediction we got over this week from Larry Williams, the incredible market prognosticator and historian. I trust Larry, and I don't like going against him. Larry sent us his thoughts on Monday, and he used a term that made me concerned. He said that the rally was kaput. Mind you, this was on the 8th day. The word kaput has some ominous connotations, right? Especially because we didn't take out the highs of the averages despite the 8-day win streak. Worse, Larry's charts showed tough sledding for the S&P 500 next week, led by the most important stock in the entire market. Maybe the most important stock I've ever seen, NVIDIA. Given that the market's overbought, plus 5 on the S&P short-range oscillator that I follow, the idea that the rally's kaput has some resonance. Doesn't help that NVIDIA's run up rapidly into the quarter, and the expectations have gotten out of hand. The stock did a horrible reversal today. Just painful to watch. So what's taken on the chin here that might have just been grazed in a more generous market? I want to give you some examples to tell you how tough this market has gotten, even versus a week ago. Why don't we start with last night's guest? Let's start with Snowflake. That's the data storage and analytics company. Snowflake beat the numbers. That raises forecast. If you listen to the interview, you might have thought the stock would be up big. But if you were a bear, you'd say Snowflake has to spend a great deal of money to ensure that its customers can store data in the cloud and then also put it to work, prosecuting the data. And that's what competitor Databricks is doing. So that's what maybe Snowflake's got to do that too. They're in a dogfight that they might be losing. And that's why margins are down so much. And that's what people looked at. The glass half empty thesis rocked the stock today, sending it down nearly 15%. Seemed excessive to me, but who am I? Or how about Williams-Sonoma, which delivered solid numbers, but then got beaten up, down more than 9%. Why? Furnishings. Oh, man, that's a tough business for anyone in it with rates higher. Listen to what CEO Laura Alper, who's really great, had to say, quote, there is no doubt that the home furnishings market is challenged due to the uncertainty in the economy coupled with slow housing. This leads us to believe that we may not see the back half of acceleration that we expected, despite all the hard work we have done to improve our product offer and our customer experience. Ouch. During the glorious 8-day run, we would have just said that Alper was being come cautious, and Fed's going to save the day when it starts cutting. Ignore her forecast shade down. Just think about the positives. Not today, though. Today, Wall Street was rational, and the stock got hurt bad. How about BJ's Wholesale Club? In an era of escalating prices, BJ's worked hard to keep a lid on the customer's costs. CEO Robert Eddy pointed out that the company has, and I quote, invested considerably in order to make our members make their baskets work within the confines of their budgets. Hey, pretty good, right? He said that's part of the company's DNA. But then he adds, these investments may pressure our short-term results. Oh, no. During those fabulous 8 days, we would have ignored that phrase entirely. People would have been focused on how terrific it is that BJ's is fighting inflation. That era is almost over. Now, instead, all we think is cutting numbers BJ's, and the stock gets pulverized, falling nearly 7%. The bottom line, my hope is that we're somewhere between Larry Williams' kaput analysis and the days when everything goes up, both good and bad. No matter what, the market's still too overbought and we got too hopeful, and now reality with its positives that get rewarded still and its negatives that are punished has set in. So the time for big gains may be behind us for a bit as we recharge and shed our Panglossian rose-colored glasses. Let's take some calls. Let's go to Mark in Wisconsin. Mark.
Dr. Cramer, thank you for taking my call.
My pleasure. What's up?
I got a merger for you in the healthcare REIT sector. The company we owned in our IRA, Physicians Realty Trust, was taken out in an all-stock merger by Health Peak Properties, ticker DOC. What say the good doctor? Buy, sell, hold?
Okay, look, people are going to be really interested in getting yield, and that is a very high-yielding REIT that's done quite well. So I'm going to have to say I endorse it. That said, look, it's at its high. It's like realty income. Let's say you call me realty income. That's at its high. A lot of the ones that yielded 6 are now yielding 5, and they come to play. I think yours is one of them. Let's go to Eddie in Texas. Eddie.
Good evening, Jim. Thank you so much for having me online and for all the great work you do for all of us, helping us get rich. My question is regarding Starbucks. With the recent CEO change, is Starbucks a buy heading into 2025?
Yes, the answer is Starbucks is a buy. But you got to be a little more patient. Brian Niccol, who's come from Chipotle, is fabulous. Will it go straight back to 100? No. Will it go from 92, 88? No, it's never going to be the same because Brian Niccol is that fabulous. CEOs matter. We tend to treat them as if they're all the same. They're not. Niccol's the real deal. I like what he's going to do. Nathan in Texas. Nathan.
Hello, Jim Cramer. I got one question about Carvana.
Sure. All right. Go ahead.
I noticed that it's at a high price. Should I hold my shares or should I sell?
Okay, today it had what's known as a bad island reversal, went all the way up and then came back down. Now, I will tell you this. Ernie Garcia is kind of an unstoppable force, and as rates go lower, he will do even better. Do not buy this stock right here at 153. Let it come in. It's been hanging here for a couple of weeks. If you can get this stock in the 140s, I would start picking some up. Hey, let's go to Ann in Indiana, please. Ann.
Jim, I'm a club member. Thank you for everything. I wish I sounded as smart as Dave in Illinois, but this Abbott thing, or Are we just like monitoring this since Lily?
Okay, I got the whole lawsuit thing down. We got one more lawsuit that's done in September. It's going to be in the same jurisdiction as the bad one where they got the very big verdict. I think that verdict's going to be brought down. I think they'll lose the next ones too. But we're holding on to it for the trust. Why? Because Abbott's a great company. In the end, these are product liability suits. They are not mass tort action like J&J. And I think we'll come out ahead of the game. They've got 4 great product lines that are selling fabulously. The market is still too overbought, people. We got too hopeful. So now we might need to be, take a brief respite. There's nothing wrong with that. Maybe a little buyer's remorse, throw that into Mad Money tonight. How is Gen AI shaping the fintech space? I'm checking in with the maker of TurboTax and QuickBooks after earnings to see how much credit we should be giving them in the latest quarter. You know how good they are. Then cruise line Viking has been sailing higher since its IPO, but it pulled back on today's report. I'm going to talk with the company's captain, learn more about what's going on. And how could a rate shakeup affect Fortune Brands in its line of home products, which are the highest end? I'm sitting down with the CEO to get a better read on how the company's doing. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
After the close today, we got results from Intuit, the software powerhouse that you know as TurboTax, QuickBooks, Credit Karma, and MailChimp. They're basically the king of bookkeeping. The company delivered a big sales and earnings beat with a better-than-expected full-year forecast for the new fiscal year. It was a solid showing for a company that supports all sorts of small and medium-sized businesses and individuals trying to figure out how to save money, grow their businesses, and get the accounting right. If you are like me, a serial starter of businesses, you know how invaluable this company can be. We wanted to go straight to the source, which is why we checked in with Sasan Goodarzi, the president and CEO of Intuit, earlier today. Take a look. Mr. Goodarzi, welcome back to Mad Money.
Thank you for having me, Jim. Great to see you.
Well, I see many good things in this quarter, and I want to go over them because it's indicative of the fact that some people felt when you, let's say, move some people around, or some people said a reduction in force, that there must be some concern that the quarter's not going well. That's clearly not the case, correct, sir?
That's exactly right. We've got great momentum, Jim. The company grew 17%. Our small business group grew 20%. We've got great momentum in Credit Karma. And we're excited about next year. We just guided 12 to 13% top line, all segments, strong growth. So we're excited to deliver for our customers.
As small business and self-employed group, which I regard to be the backbone of the U.S. economy, makes me feel very, very positive here. Or is it also that you're just taking a lot of share and I'm feeling positive about your business?
Well, first of all, I want to start with where you did. Small businesses drive the global economy. They drive the global hiring. They're special entrepreneurs. And really the reason we're accelerating growth is we now, Jim, have a business suite. And our business suite gives the ability for a small business to be able to grow and run their business all in one place. And our AI capabilities are powering the work to be done for them. And so we're creating campaigns for customers. We're helping manage their cash flow. And then it comes with AI-powered experts by their side. And so that's what's really driving our growth to fuel their success.
You know, when I was going over with Ben Stoto as research director, we were trying to figure out which is more important, or maybe both, the generative AI that you use internally to make it so people are more productive, and therefore you're getting more out of each person, or what you're showing your customers, which is clearly way above where you might have been even 2 years ago.
I love the question. We believe both are critical. In order to actually reinvent experiences for customers, we actually have to reinvent the work internally. And so a lot of our generative AI capabilities and data investments internally are to make our engineers more productive, to help our customer success agents, to help our marketing folks, because the more we make them productive with the tools that they use, the more they understand how to actually reinvent experiences for our customers. And so that's a lot of where our margin expansion is coming from, because our teams are more productive, and then we can deliver more innovation for our customers. So both are critical in our mind.
Okay, I want to just pursue this a little further because there are many people who say, well, they use AI, but your business is unique in that you have millions of pieces of data, but we only have our own data. So we don't know how to use you. Are you able to explain to people how you can take advantage of everything that Intuit has and therefore make informed decisions? Because I think people often shop to see who's the best. I know I always settle on you for every business I've started, but I now realize that you have the full panoply. You actually can advise me. You could always help me, but now the advice would be true to the cohort that I'm in.
Yeah, Jim, first of all, as you know, but for your audience, we bet literally the entire company on data and AI almost 6 years ago because we believe that we needed to bring professional grade services and capability to consumers and businesses of all sizes. And really the crust of what you articulated is spot on. And that is, we have about 500,000 data points per small business, and it's our customers' data, it's not ours, which means we see all of the money coming in, money going out, the vendors you deal with, the employees that you have, the contractors that you have, and we leverage all of that data and apply AI capabilities to do things like create a marketing campaign for you where you're in control to help project what your cash flow is going to be and how to access more money. Or do you want us to remind your customers to pay overdue invoices when you're on the road, just taking a picture of a handwritten estimate, and then we'll turn it into a digitized estimate in the platform for you. Those are really about bringing professional grade services to hardworking businesses. And we absolutely believe not only it's critical for today, but it's the future of everything is done for you. You're able to focus on your customers. We bring professional grade capabilities to you to power your prosperity, to power your growth, which ultimately powers the economies around the world.
Can I lower my accounting bill? Can I lower my accounting bill because I can ask things that would cost me per hour a great deal as a small business person, and I can't afford the upfront cost? Can I use Intuit, lean on Intuit for that?
Well, I'll tell you, the short answer is yes, but I'll tell you what we hear from customers. They're spending less time having to do the work because we're doing the work for them, less errors, better ability to manage their cash flow, better ability to be able to grow their business because we're putting campaigns together for them that's based on their data, who's buying, who's not buying, which customers they should focus on. And it's actually making our businesses far more productive. They pay less for labor. They're getting more customers at a cost-effective way, all because we're digitizing their entire business.
Okay, now I do have to ask, and I know it seems niggling in light of the large things that we just talked about. I see total U.S. TurboTax units minus 1% change year over year. This is the type of thing in this suddenly more negative market. Some might just say, you know what, I heard all that stuff that those guys talked about. That's all positive, but I'm worried about TurboTax units. What do we say to people who are looking at one piece of data and making a decision about your company?
It's a great question, Jim. We're pursuing a $35 billion total addressable market, and that in tax. And out of that $35 billion, $30 billion are those that have somebody else do their taxes for them. It's the majority of our growth opportunity. That actually, our total revenue in that segment grew 17%, and our customers actually grew 11%. That's where the opportunity is. That's where the growth is. And that's really what investors and your audience should be looking at, because that's actually what's driving the 7% growth that we delivered this year. And we think the upside is massive as we look ahead. And
are you concerned at all that if the Fed doesn't cut rates soon, that there will be fewer small business formations?
Jim, not at all. Because when we look at the history of the company, whether small business formations have been strong or when they haven't been strong, it actually has not impacted our growth at all. And the reason is out of our $300 billion in total addressable market, $200 billion are existing businesses that use shoeboxes, manual methods to run their business. And that's our opportunity for penetration. And of course, there will be years where formation is strong, years where they won't be strong. Net, we don't ebb and flow with that. But it's important for the long term. If you look at 10 years from now, this small business formation will be important.
Excellent. Okay, that's what we want to be thinking about. You have to think long term. A lot of people have been selling things on quick draw stuff suddenly. I don't want that It's how they lose instead of make money. I want to thank Susan Goodarzi. He is Intuit CEO. Congratulations, and let's hope people see through a line or two that they might not understand for the forest that is clearly terrific. Thank you, sir.
Thanks for having me, Jim.
I'm going to be back in the break.
Coming up, set sail with Viking? See what waves the cruise line made with earnings. Next.
What do we do with the stock of Viking Holdings, the destination-focused cruise play best known for its river cruises in Europe? Today, Viking reported Wall Street didn't really like the results, even though I thought it was a strong set of numbers. Management had some very good things to say about bookings momentum for the rest of 2024 and 2025. However, the earnings per share came in light, and they also had a slight occupancy rate miss. Throw in the fact that the stock was up big going the quarter, and you can understand why people use this as an excuse to ring the register. And that sent the stock down nearly 9%. Earlier today, we got a chance to speak with Tor Hagen. He's the chairman and CEO of Viking Holdings. Take a look. Mr. Hagen, this is your first time on Mad Money, and I wanted people to be introduced to the great Viking because you're quite different from the other cruise lines that we may have been looking at. So tell us a little Viking 101, please.
You said it. We feel we are different. As a matter of fact, we are so different that we have decided to drop the word cruise from our name. So we now call ourselves Viking Holdings, but we're really different from the other guy. The other guys are great too, but we appeal to a totally different segment of the population, and we have a very different product. So you can say we like to appeal to grown-ups, 55-year-old plus, with time, money, and above all, curiosity. So we call ourselves the thinking persons. And then we use the ugly word cruise, but we are thinking person's journey, really. And that has served us well.
But we also want to point out that there are no children running around, not that there's anything wrong with children, and there's no gambling. And I also understand there's no nickel and diming.
Absolutely. I think, many of these big guys, they've made larger and larger ships, and they've added more and more features. And of course, it's great to take your grandkids on a roller coaster, in a car, on a big ship. But our guests are people who are tired of all that. They're tired of their own children. They're even tired of their own grandchildren. But they want to experience things. And I mean, that's a trend in today's life. The modern luxury is that you can have experiences, and that's what we deliver. And we started on the rivers, of all places, in Russia. 27 years ago. Now we don't do a lot of business in Russia today, but that was a start. That was the start of Viking, and I've known the ocean cruise business since I was much younger. But what we have been able to deliver is really quite spectacular, and our guests rate us number one by all means.
Now, can you give us a sense about whether the people over 55, the people who are signing up, view you as a value offering, or do they accept the fact that you're premium and don't necessarily come in at a lower price, and they're willing to pay for it because it's such an amazing experience?
Well, I think you hit the nail on the head. I think, of course, it's, dollars off and all that attracts customers. But we feel it's very important that when people go on Viking, they know exactly what it costs, no surprises, pay a full price, and we get fair value. Don't get me wrong, but there shouldn't be nickel and dime, and you shouldn't come aboard a ship and experience that you are there to be fleeced. And that, I think, is a business model of a few other people.
I do want to mention that the other cruise lines were really totally attuned to how booked they are. In a seminal moment in your conference call, you talk about how sometimes you don't want to race your bookings because you want to optimize. You want to keep some back. I'm not sure all the analysts understand that, but you actually can do that because there might be some latecomers who are willing to pay more.
Well, not only that, but I mean, we have been booking quite far ahead, quite frankly. And if we look into 2025, we have already sold out 55% of our capacity for next year. And you can say that's a tad on the high side because it's nice to have a little bit of goods on the shelves when you start a new year too. So I think we are happy. Of course, one is always happy when bookings are high, but I think it's nice to be able to also have some goods available as people make their decisions later on in the season.
One of the things that I think is quite exciting is for this group of people that you're mentioning who don't mind paying full price, world-class lecturers, cultural partnerships. These are things that are almost antithetical to Wall Street. They don't think there's enough people who actually still want to learn. It's really quite the opposite, isn't it, sir?
Absolutely, and I'm currently outside the target group myself. I think on the high end of the group, but heck, I think we all like to learn. If there's a day, we should try all to be a little bit wiser when that is done. And of course, we have been very fortunate to have a lot of cultural affiliations. We are particularly proud of one we have had in the UK, the Downton Abbey, Highclere Castle. But everywhere we have these kind of relationships where we have exclusive access. And this people want to experience. Now you can say, not always want to be a lord or an earl, but it's nice to see how these guys used to live, at least.
Well, I've got to tell you, when I look at what you're doing, I realize that we all do. Baby boomers, people in the generation that are my generation, we have disposable income, but we don't want to just dispose it, and we don't want to just take a trip to nowhere. What we would want to do is learn, have beauty, but also meet other people, like-minded people. It does seem to be that you have a cultured group, of which I have to tell you, I want a cultured group when I go on a cruise.
Yeah, I mean, I think you make the point immensely well. And I think when I've lived a long life, you start to realize there's really one scarce resource, truly scarce resource, and that is time. And then I say one shouldn't waste one time doing stupid things. One should spend one time getting something out of it. And that's why I think we have such a great product to offer. I must admit, I took my first vacation in 27 years, a year and a half ago, and I'm a cheapskate, so I went on our own Antarctica cruise together with my neighbors and my best friend. And of course, it was a phenomenal experience to be on one's own little yacht. But it's this type of stuff that our guests want. And you can go along the rivers of Europe. And of course, that's where the civilizations developed and have exactly the type of experiences one should have when one gets to a certain point in life. And our ocean cruises, which we started in 2014, we did it differently. As you said, no children, no casinos. People say, you must be nuts. You have to get that extra revenue from the casinos. I bet you if you did the calculation of what the space cost and what the croupiers cost and all that, it's not so much left over. But it leaves a lot of noise. Our ships are quiet, subdued, elegant, and you can go there to relax. So it was quite fantastic. We started then with 2 ships in 2004, or 1 ship in 2014. Now we have 10, and we are rated #1 by all these wonderful magazines. And we have another 10 ships coming, so we can't really complain.
That's very good. Well, I'm excited about your company. I'm glad you came on us first. It means a great deal to me. I want to thank Tor Hagen. He's the chairman and CEO of Viking. Sir, it is really great to have you on the show. Just fabulous.
Well, thank you very much for having us, and you know where to go next.
You betcha. Thank you so much. I'm going to be back after the break.
Coming up, fortune favors the brands. Should investors feel at home with the security stock? Find out next.
This is the point in the business cycle where you're supposed to buy the stocks of companies that'll get a big earnings boost once the Federal Reserve starts cutting rates. That includes everything that goes into a home, because most of the stuff is paid for with mortgages or home equity loans, meaning it's extremely sensitive to interest rates. Which brings me to Fortune Brands Innovations, which makes all sorts of plumbing, security, and outdoor products. When the company reported last month, the numbers weren't perfect, but the stock still rallied more than 9% the next day. I think because business is fairly strong, and also because this isn't your father's faucet lock company. So let's check in with Dick Fink. He's the CEO of Fortune Brands Innovations to learn more about where his company is headed. Mr. Fink, welcome back to Mad Money.
Thanks for having me on.
Oh, thank you, Dick. Now, I've got to tell you, there's been a time where I would adjust your stock be going like this because you're connected to housing, and now it's going like this because you're not as connected with housing as people think. You're connected to technology.
Look, we love the underlying housing market. It's underbuilt. We think there's huge opportunity there. But you're right, it does have some cyclicality to it, and where we've really focused the portfolio is what are the supercharged parts of the market where we can really dial things up. Technology, connected, some of our products are AI-driven, is one of those places, and we're starting to really see that come through the P&L now.
Well, I think that the insurers and some states are recognizing the importance of, say, stopping damage, and also the need to be able to ration water. And I don't think anyone else has the technology you offer that really will fit in with this new regime.
Yeah, well, look, it's, as you know, a crisis of affordability and insurance, and we have technology that can literally take cost out of the system. It's a win-win, right? We can take cost out of the system, and I fundamentally believe ours is the best, and we back it with a ton of investment to bring this thing to life. But now what we're starting to see, which is really breakthrough, is insurers starting to mandate that these products go in, and municipalities starting to offer enormous rebates for these products to go in so they can lower their costs. Now, those get passed on eventually, but they're trying to take cost out of the system, and we have the tech to provide that.
They can mandate what they want, but if you don't have the technology, it doesn't work. You have the technology.
Yeah, we were very, very careful. When we acquired this technology, it was the leader, that was the kernel, and then we've invested in developing that technology behind it. And now, our connected products business in totality, will approach annualized revenue of $300 million by the end of this year. It's profitable. It's got a couple hundred engineers. And so you need that kind of scale to keep the technology at the forefront all the time.
Now, I think that all of your documents would read so differently if you didn't have China. And I feel bad because every time we talk, we've had to mention China. And China, you're talking about down like 30, 35. Now, it could have sunk you. You had a lot of business in China, but somehow you've managed to make it so it's more of an asterisk than it is a cliff jump.
I'll tell you, China has been rough the last couple of years. There's no question. Our business is hot in China. Our team has done a phenomenal job managing the cost of our business and reorienting the business to what will be an R&R market in a way that hasn't really negatively impacted our shareholder. At this point, where it is, I'd say from a profitability perspective, it's not enormously material, so we're not too worried about the downside, but it gives us a lot of upside optionality, both when that market comes back, but also it's an innovation engine for the whole company, and we like that.
Now, they famously like to spend, when things were good, they spent to make their apartments fantastic. Are there things that they like that we now are using here?
Well, you see a lot of adoption of innovation, right? Which is why it's an innovation engine. So you think smart toilet, which only kind of started to catch on here around COVID. Massive adoption over there. In fact, our mix is, I think, 40-50% smart toilet in our sanitary ware business. And so it's really things like that they're much faster to adopt emerging technologies that then eventually we bring across the Pacific.
Now, the decking business is a tough one. Now, Trex had a tough quarter. ASIC's kind of hanging in there. Where are you fitting in among those competitors?
We've really focused that business on the upper end. We purchased what was an entry-level business, mostly retail. We focused on building out the wholesale and higher price points. We've done a really nice job of that, so you saw that come through in the recent report. I think the next step for us is really to dial up the brand building and innovation, which is what you should expect from Fortune Brands, right? And so, we've spent a lot of time building out the supply chain, building out distribution. That's really the next step.
And then in the meantime, home security, security safe, we have what you produce, and we also, and the locks, these are kind of the generic locks, so everyone knows them, but you're making them in digital too.
Yeah, well, there's really a couple parts to that. Just the connected lock. We acquired Yale, so we now have access control with the best brand in that field. But a third of that business is now actually commercial, which is a safety business, lockout, tagout, and we're going to digitize that too. We think that's a $3 billion addressable market that we can go after as a leader in really taking manufacturing sites and making them a lot safer, leveraging a digital backbone. So we're very excited about that.
Well, the way I look at your company is that you are doing well without the Fed cutting, but if the Fed cuts, you may not even need to worry about China, and we won't, fortunately, maybe have to discuss it next time. Unless they get it right, that would be terrific.
Yeah, we're looking forward to it.
Yeah, they could get it right. Can't rule them out. That's Nick Fig. He's the CEO of Fortune Brands Innovations, one of my favorites because I'm always looking for housing plays. You know that. But I don't want to have my housing play fall through to the basement. Mad Money's back in.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. Here's my round for calls. One another saying, "Mr. Talk, bye. Sell some stuff near the course worth. Everybody plan this out." And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. It's going to go to Kevin in New York. Kevin.
Booyah, Jim.
Booyah, Kevin.
Thank you for taking my call. Last month, I recently began a position in Micron Technology, ticker symbol MU, and this was before everything had a little meltdown. Wanted your take on that. Should I buy more?
Okay, so Micron bottomed. It was straight down, and then when Sanjay Mehrotra came out and they reissued their buyback, it hung at 92, then bounced back all the way during the period of euphoria. Now it's coming back down. I think it probably goes to 98, 99. I would buy more right there. Steve in Florida. Steve.
Hey, Jim. It's Steve in West Palm Beach.
Fantastic. Wish I were there. What's up?
We are fans all the way back to your Kudlow and Cramer days.
Whoa, dates me. Thank you.
I have a beginning position in this 150-year-old small-cap industrial company with a 36 PE and a pretty good-looking long-term price chart. What do I do with Crane Company, symbol CR?
Okay, so I was thinking about putting Crane into our new industrial series that Chief Scientist and Chief Research Director Ben Stoder and I are putting together. It is a very well-run company that is totally pivoted and does very little metal bending. It's a high-tech company. I like Crane. It's maybe up there soon. I mean, we're working on some in the HVAC category that are actually interesting, believe it or not. Let's go to Zach in Louisiana. Zach.
Hello from New Orleans, Mr. Cramer. Thank you for what you do for me and my family, and shout out to the New Orleans Saints fans. Who dat?
Like that. What's up?
All-knowing Professor Cramer, 3 years ago, I started a position in this data center and data lifecycle management company. Now I'm sitting on 150% gain. With a current 2.69% yield, what say you regarding Iron Mountain, ticker symbol
Okay,
IRM?
look, we liked Iron Mountain at 5% yield. We liked it at 4% yield. Now you're starting to get very little yield, and you're going to acquire the growth. I suggest that you actually sell some Iron Mountain, maybe take out your costs, and let the rest run. That would be the wise thing to do right here. George in Michigan. George.
Hey, Jim. Thanks so much for taking my call. I appreciate all your advice. Quite some time ago, you made a recommendation on L3 Harris, but since July's earnings report, it's kind of plateaued down, and it's stayed pretty much flat since then. What's your read on it now?
On L3 Harris, I think it's driven. And I'll tell you why it's driven, because it has that combination of high tech and defense that are two very strong long-term trends. The previous CEO is someone I know. I don't know this current CEO, but LHX is fine. Let's go to Henry in Arkansas. Henry.
Booyah, Cramer. My name is Henry Hunley. I'm a law student here at the University of Arkansas in Fayetteville. I've been watching your show for about 10 years now, and I'm a huge, huge fan.
Well, we love Fayetteville. We love J.B. Hunt. We love Tyson. We love Walmart. We're all in.
Well, you would think, being from Northwest Arkansas, I'm calling to ask about Walmart, but really my eyes are looking west in Oklahoma City towards an oil and gas stock I've been following for a long, long time called Devon Energy. It's got a great price-to-earnings ratio.
I think Rick Moncrief has put together a monster company. I actually like the acquisition very much. He did in the Bakken. He knows the Bakken really well. I'm surprised that Devon is as low as it is, but remember, we got natural gas at 2 and we got oil trying to keep out of the 60s. So I would own Devon, but don't get excited, okay? Let's go to Greg in Virginia. Greg.
Booyah, Jim. How you doing?
I am doing fine. How are you?
Good, good. I had a question on Intel. I'm a longtime shareholder, and obviously last month has been tough. big sell-off. With them trying to restructure, do you think they can take advantage of the AI market? And where do you see a bottom for another buy-in on the stock?
I think that Intel is getting whacked by AMD. I think has nothing that can possibly lay a glove on NVIDIA. And I got to tell you, I much prefer ARM Holdings. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
When Amazon reported 3 weeks ago, the quarter was widely panned, with sellers focusing on how management suggested that consumer sales could be weaker, although they also said one day they're going back. The idea that the crazy news cycle from the assassination attempt on a presidential candidate to the Olympics could cause daily spending to drop was viewed as a dodge. According to critics, overall spending must be slowing on Amazon, so you just had to bail. Sell, sell, sell. They also didn't love the spending on essentials was higher because that stuff carries lower margins. Next thing you know, this $184 stock is bumping down to the $160 level. All mentioned in the endless obituaries that I read about Amazon after its quarter. Of course, we bought it for the charitable trust right in the teeth of that collapse. And yet, fortunately, it didn't take long for the stock to recover, almost back to levels where it was declared dead. And now we're looking pretty good. But the stock did drop $4 today. Now, did we just get lucky on that rebound? No, it's just that the reports of Amazon's death were premature. Let me go through the reasons why it's so difficult to part with Amazon stock, starting from point one. It's difficult to part with Amazon itself. As much as I like Walmart Plus, it's the sack of packages from Amazon that greets me when I get home almost every evening. It's no different from how I have to check my Instagram feed every day, how I use Microsoft Outlook, and now ChatGPT, or how I wouldn't part with my iPhone. And I wouldn't even know what to do on football Sundays without YouTube TV. Necessity is the mother of higher stock prices. Second, I've been adamant that the consumer wants lower prices. Costco, TJX, Target, Ross Stores Tonight, and Walmart, they give them to you. But nothing comes even near Amazon Prime Day. Nothing's cheaper. Nothing. Third, I believe Amazon's alibi for missing sales. It makes a ton of sense that there could be more shopping on some days other than other days, right? And these guys need to keep the flow going. That's why they pushed the NFL to have a game on Black Friday. If they can get you to stay home and order during halftime rather than go to the mall, that's a win. Maybe they shouldn't have the Jets this year. Why not believe Amazon when they say the Olympics are an attempt at a Saturday assassination interrupted ordering? When in doubt, I say believe in Amazon, not the analysts. Fourth, Amazon does not stand still. If you don't think they can cut the cost of spending to send you those cheap essentials, then you don't know the way Amazon works. Getting costs down is what they live for. I believe they'll figure it out. Plus, historically, it's been a huge mistake to camp these guys out. Fifth, let's get this straight. If Amazon takes over the essentials market, the consumer habits change. And you might just cut out the local supermarket or Walgreens or CVS entirely. We know the drugstores are challenged already. They can't afford a price war with Amazon, for heaven's sake, with its incredible scale and convenience on its side. Sure, you need to wait for your package, but that's less frustrating, I think, than waiting for a CVS sales associate to open the case where everything's worth buying is locked up. Finally, we all know this. While Amazon's retail operation is important, the big money is in Amazon Web Services, their cloud business, which is getting stronger and stronger and stronger. It was fantastic this quarter. I'm not going to sell this stock because it had a couple of tough shopping days. No, the stock isn't cheap. But when has Amazon stock ever been cheap? Amazon was down with the rest of tech today, even as it's still up significantly from its post-quarter lows. I think it's worth buying into weakness. The tech titans always have a way of coming back. You need to buy them when they get clocked, and really only when they get clocked. It's literally the only time when you can buy them for a bargain price. Now, look, maybe it's not as much a steal as Amazon Prime Day, but I think it's still pretty darn fabulous. I'd like to say there's always a bull market somewhere, and I promise I'll find it just for you, right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.